And here we are.
Good morning, everyone.
Good morning. Good morning. Good morning, Spencer.
Good morning.
Thank you so much for joining us today.
Yeah, thanks for having me on.
Absolutely. Absolutely. So you have some really exciting stuff that we want you to share, and I'll introduce you officially after we get through our numbers. And Tricia, we added a couple new banners this week too. We were evolving into identifying other things that people might want to know about.
I'm still working on my chart.
Oh, and it's progressing. Yeah, as soon as that data gets there, you're gonna
be able to see the trends a little easier. So, but with just a couple weeks, it's not that exciting yet.
So why don't we get right into the numbers so that we can then have Spencer talk with us. Yep. So new active listings staying pretty consistent with last week, 302 this week is 303, and then 348 2 weeks ago. Coming soon.
This is pretty consistent too. Yep, 66. They're up. So, and actually we looked a fourth week out and that was 52. So the coming soons are coming up.
Yes, they are. And so one of the things that we prompted to start a new conversation was how many homes are currently available in Bucks, Montgomery, and Lehigh County? Those are the three counties. So if you are a buyer right now, there are 2,250 homes currently for sale.
You got options.
Well, yes. And again, that goes by price point. So who knows what those options look at. But what's also promising is that months of inventory. So October had 2.5 months. In September and August, we were only at 2. So we are starting to see an increase in inventory. And I think that a part of that as well is the fact that the interest rates being as high as they've been, we don't have as many buyers that are out there looking.
So this is still a seller's market for sure. Once we get to 6 months, that's more of a balanced market, and anything above then becomes a buyer's market. So right now, still very strong seller's market.
Under contracts.
Hey, can I just?
Yeah, go ahead, Spencer.
Can I just ask you a quick question that maybe the audience has? So the coming soons, I know that there was, I think there was some rules put in place on like what that means. Mm-hmm. So is there a timeline that if it's listed as a coming soon, it has to be on the market within a certain timeline?
Yes, that's a great question, Spencer. So we are allowed to put in the MLS, the multi-listing system, a coming soon for no longer than 21 days. So anything less than 21 days, it can be in an active coming soon status. But once you get to day 22, it needs to be an active listing.
And we can't show that. So if it's in a coming soon status, you can't show it to anyone unless you show it to everyone. However, you can write an offer sight unseen.
Yep, exactly.
So that has happened before, but not allowed to show it until everybody can see it.
Cool.
Great question. Thank you. Back on market, 57 versus 48 the last couple of weeks.
And again, I think a lot of that is attributed to interest rates.
And I think also the fact that we are back to negotiating. So there are home inspections that are now being accepted, and there are inspections that, because of negotiations not being able to clear up, that things are going back on the market.
Yeah.
And then price reductions.
A little bit less. So we had 216 from 235 and 275 2 weeks ago. So heading a downward trend to that again.
Right. But now that we've gotten through those numbers, I want to introduce Spencer Davis, and Spencer's with Benchmark Mortgage. Thank you, Spencer, for coming on today and talking. Guys, so Spencer and I met this past week. We had a one-to-one, and we started talking about ARMs. And it's not something, I've been in real estate now for 8 years. Tricia, you're 7. And I've never had a buyer purchase with an ARM, which is an adjustable rate mortgage. I had one way back when I was a first-time home buyer myself, but it's something that you were educating me on, and I'd like you to educate the audience. So can you explain what an ARM is and why it is not as scary as it was 15 years ago?
Sure. Yeah. So I've been in the business almost 17 years, and my experience isn't a whole lot different than you guys. In my first, 16 years in the business, I probably can count on one or maybe two hands the amount of clients that have used an ARM. So, but right now I have a handful of customers that all have chosen to. So ARM is an adjustable rate mortgage. So just acronym ARM for adjustable rate mortgage. And typically the ARM is going to have an initial fixed period, and then it is going to adjust like based on a periodic timeline that's determined up front, typically once every 6 months or once every year. So the ARMs that I would say are pretty prevalent right now, you have a 3-1 ARM, 5-1 ARM, 7-1 ARM. And then to complicate it just a little bit more, there's also 5-6 and 7-6. So real quick, what that first number means is that's the initial fixed period. So on a 3-1, the 3 is the initial fixed period for 3 years. 5-1, the initial fixed period is 5 years. 7-1, the initial fixed period is 7 years. And then the second number is how often it adjusts after that initial fixed period. So the one, if it's 5-1, 3-1, 5-1, 7-1, it adjusts once a year after the fixed period. And the 5-6, 7-6 actually adjusts every 6 months. So that's just kind of the basic structure of the ARMs. I don't really like 3-1 or anything shorter than that, just because I think it's not, I think you want a little bit longer fixed period in this environment. But the 5-1s and 7-1s, or the 5-6 and 7-6, I think have some attractive rates right now that a home buyer should at least consider. Compare it to the 30-year fixed and see what the cost savings is on a monthly basis, and do a risk assessment and go from there. We're seeing the 5-1, 7-1 anywhere from maybe mid 5s to low 6s on the rates. And, if you're looking at comparison to a 30-year fixed at maybe, 7.25, 7.5, if it's a $400,000 house, could be $350 a month savings. Right. I had a client last week that just closed on a purchase in Center Valley, and they used the 7-1. And it saved them $340 a month.
So these, they kind of get a bad rap, these ARMs. So,
I want to get clarification on something quickly. So let's say it's a 7-1 and you have great credit and you're in the high 5s, low 6s, and you're in year 4 of this rate, but now all of a sudden interest rates have lowered and it's in the low 5s or high 4s. Can you refinance while you're in the middle of this first 5 or 7 years? Can you still refi?
Yes, absolutely. So, and that's a good segue to the question that Trisha was asking. So the current ARM products do not have any prepayment penalties, which means you can pay it off at any point with no penalty to you as the borrower. The old ARMs that scare everyone and gave ARMs a bad rap started in that subprime loan period, early 2000s to like 2006, 2007, 2008. And those products, I think most loan originators would say that those were a predatory mortgage product. They had an initial fixed period of just 2 years, so very small. The prepayment penalty was 3 years. So most borrowers that had those 228 ARMs, they were unable to get out of it until, like, they couldn't pay it off until after they already faced one adjustment. And the current ARMs have adjustment caps. So the one that we use pretty prevalently right now has 225 caps. So what those caps mean is that the initial adjustment can't exceed 2% up or down, could actually go down, believe it or not. And then subsequent adjustments can't exceed 2%. And then the total adjustment over the life of the loan can't exceed 5%. Some of those old ARMs, so they're not tiny amounts, but they're not huge jumps either in interest rate. Those old ARMs, the 228s that were subprime loans, some of those may have 6 to 8% caps on the initial adjustment. So someone could have had a 4% rate and then it goes to 10 or 12 in year 3. And that was an astronomical difference to the monthly mortgage payment. And those borrowers couldn't refinance out of them because of the prepayment penalty, or if they did, there was a big penalty to them. So those arms were not good for the consumer. They were not good for the industry. They led to the housing collapse that we dealt with in, that late 2000 period.
Right.
So guys, I think that at this point, if anyone has further questions, Spencer, how can they get in touch with you if they want to dig in deeper to the numbers?
Yeah, so one, they can always reach out to you guys. It's your viewing audience. So I'm sure you both have my cell phone number and could route them to me. But our local benchmark branch site is lehighvalley.benchmark.us. My local site is spencerdavis.benchmark.us. And my cell phone's 484-201-8366.
And I want to just give you a shout out. Spencer does some awesome videos educating buyers and realtors. Really, you're educating people, and it's really great. So follow him on social.
Yeah, my Instagram's probably where I post most of them, and they kick over to Facebook. But Instagram is Spence Davis 12. And yeah, that the reels that I shoot on there absolutely are. The intention is to educate or encourage, one of the two. But I'm not looking to clown around and entertain with weird dances or anything.
Hey, don't knock it till you try it, Spencer.
Spencer, thank you so much, guys. If you have any questions and you want to just throw them in the chat for later, anything you want us to talk about next week, we are here for you. We are here to give you your weekly real estate recap. And thank you very much, Spencer Davis.
Thank you, Spencer.
Yeah, thanks for having me.
Guys.